the market takes a moment of silence in pure complacency, it actually brings some of the best opportunities of October. And today is October 18th, 2019, Friday. Some phenomenal opportunities are in development. So here's the story that you may be hearing all over the place. The consumer is so strong. The economy is so damn good. Oh, that's why the stocks are going higher. Damn it, the stocks are about to drop harder than you have ever pictured them in the entire history of this damn stock market. The consumer is so strong because they're borrowing more than they have ever borrowed in the history of the United States. Why would they borrow? Well, because the wages are not going any higher. Because they have no choice but to max out their credit cards. Because the bankruptcy laws here in the United States are better than in any other country. Why is it the fact that everybody owns their shit all over the world, while here in the United States, we don't own nothing? It's all about the credit. Now, here's the problem. The economy being at 3.5%, these layoffs is about to pile up like crazy. And people are not going to be able to pay their credit cards. So what are they going to say about the consumer then? Oh, the consumer is so weak. We didn't see this shit coming. Guys, it's about to go down bigger than you can picture ever. And there's too many signs. We're not saying the market is going to crash today. Actually, this complacency is absolutely absurd. They keep hoping for more stimulus. This is why the market is not going down, but the charts keep pointing to a drop. And we are remaining a bear, a faithful bear, today on October 18th, 2019. Second day, the observation of divergence between the market moving higher and the VIX moving higher again, pre-market. Now, here's the most important observation of the day. Brexit deal is on the horizon. Brexit deal done, not done. Hey, this stuff's been going on forever. But if Brexit deal gets done, here's one thing that is certain, is that England will raise their interest rates, which could be the very first sign of a TRO in the rates. Now, I know if you haven't been following our channel, if you haven't been a subscriber for at least a year. Last year, we were actually one of the first very few people to point out, while everybody was screaming that the rates were going to go higher, we said the rates were going to go lower before everybody actually picked up on that stuff. And so by nailing the rates reversal earlier, we were able to play the market crash, highly profitable for our subscribers. Now, this time we're saying the rates could actually go higher. Not in the sense that the rates could go higher, but as inflation could actually pick up here in the United States, okay, we're seeing that the Fed has a lesser probability of actually cutting the rates. So in the rate of change terms, as inflation picks up, Fed, instead of cutting the rates, will not necessarily move them higher, but they're not going to cut them. And that by itself could crash the markets. Now, of course, the story of the day is that the GDP number in China is the lowest in 27 years. But what do the markets say? Well, the markets don't give a damn again. Now, guys, sometimes when Chinese GDP number was reported in 06, in 08, I remember I made a bunch of money in 2018. I remember the August of 2016, guys, when the markets were going down over 24 hours by 1,000 points. Now, I know some of you have seen the markets moving lower, 600, 700 points. But when you wake up in the morning and the market is actually down 1,000 points, okay, it looks like the whole world is coming to an end. So you haven't experienced that. That shit is about to go down, guys. Not clearly pre-market today, but sometimes the market has what I call a market delay phenomenon. And I think this is exactly what's going on here. Now, clearly we're seeing some early signs that this huge drop is about to materialize. Second day in a row is clearly portrayed in this chart of S&P 500 moving higher. Earlier pre-market around 3, 4, 5 a.m. it was actually moving lower with a negative, and they're buying it again. We've been seeing this the last 3 days, guys. Every time 3, 4, 5 a.m. the market futures are actually lower in the S&P 500. They're in the red, and then magically the market pulls itself out of the rut. And interestingly, for the last couple of days, what we have been seeing is divergence. Market moves higher, but so as the VIX. Okay, the VIX is up above 14 pre-market, 0.29 higher, while S&P futures are up about 2 points. So this is not the typical relationship we see between S&P futures and the VIX, which point to actually a bearish reversal. But this puzzle is actually completely puzzled the hell out of everybody but the price action in oil. So as we're seeing a clear divergence 2 days in a row in S&P and the VIX, what we're actually seeing is a absolute clear stupidity in the price of oil. So as inventory goes up in the price of oil, we're seeing some of the biggest inventory buildups. Basically, supply goes up, okay, while demand is not moving higher. That equates to oil price moving lower. But yet, what are we seeing? We're seeing the price of oil move higher. Now, the second most stupid thing that is happening this morning is, of course, the GDP data in China. Hello, it's moving lower. The largest oil consumer is slowing. It just reported the worst GDP number in 27 years. And yet, it does not impact the oil prices negatively. The question of the day is not whether oil prices are going lower. Absolutely they are. The question is, for how much longer will they be moving higher? Because this could represent the ultimate shorting point of all times in the history of the market. So this divergence by itself is actually highly bullish. There's two very good reasons why oil should be dropping, and yet it is not. And in this video, I'll also reveal another huge factor that tells us about how stupid this market really is. And when markets get stupid, guys, this represents some of the greatest opportunities on the short side. So stay with the trade. Netflix, pure, simple, and easy, pointed out there was going to be a black candle formed on Netflix shares, suggested shorting this thing when it bounced. So for those of you that don't believe in shorting the bounces, guys, it's time to reconsider, because they do work if you time your entries correctly. So here it is. The black candle on Netflix formed intraday yesterday. At this point, we're switching our target price slightly lower, mainly because of what has actually developed on this chart. As you clearly see, Netflix shares jumped and sold off. So did the accumulation. Distribution line point to the fact that despite of this confusing volume higher, they were actually selling Netflix shares all day at these prices. So Netflix could bounce slightly at the open, but it is likely to visit the levels of 280, 272 in the next 24 hours, possibly by the end of today. So stay on the put side of Netflix and short every bounce. Nothing has changed in our projection as far as the S&P futures short any bounce between 2994, 3004, even 3008 area. Now, the earnings after hours yesterday, very cool trade. We're going to describe it in detail. ISRG. This morning, MAN, KSU, KO, SLB. All of these things we're going to talk about briefly. Considering MAN, 85, 80, 75 puts at open so far. Tiny volume. Stock jumps to 87, drops to 84. If it opens anywhere remotely between 84 and 85, short this thing. Buy any one of these strikes puts because the chart is highly bearish. Now, this stock has been in a downtrend spiral for about a couple of years. But particularly the reason why we'd want to buy puts this morning in this particular name with options that expire today is this. Head and Shoulders. Got multi-top formation. Death cross. There's a lot of pre-existing condition pointing to a further drop. MAN. Daily chart. Bearish reversal 1. Bearish reversal candle 2. Bearish reversal candle 3. Guys, this thing is going down. Represented by a very visible divergence in accumulation distribution line as well. And at the time the stock bounces, accumulation just keeps moving lower. Now, for those of you that like to play it big time trade developing on ISRG, we're considering 550, 540, 530 puts at the open, given the fact that the stock is going to open around 550, 560 area. This is the area of entry we're actually targeting on the short side. Basically, we want to short this thing on a bounce. Pre-market, it's at 546.5. We're expecting at the open the stock to bounce to about 555. And this is where we want to come in. 550, 555, this is where we want to accumulate. 550, 540, 530. ISRG puts in the expectation of it hitting the level of 535. First target, collecting some profits here. Second target, around 528, 525 area. Very simple and easy trade considering the options expired today. You can buy them cheap despite of the stock trading in a $500 range. This is how bearish ISRG chart actually has become over the last year. Now, this has been a bull. For those of you that don't know, this stock used to be at 27 bucks in 2008. Went up all to $300, $400, $500. Okay, they were going to do a stock split at then, and they actually did the stock split right around when the stock was trading at about 470 bucks. Now, they split the stock, and since then, it moved up. They split the stock 3-to-1, basically meaning they split it, and the stock dropped basically for every 3 shares down to like a couple $100. Then it worked itself way back up to $500 mark today. Basically, to make the long story short, if they never split the stock, it would have been the price of Amazon, trading roughly at about $1,600–1,700 today. Hey, not bad for good old Intuitive Surgical. Now, consider it. If the stock was never split and it traded at $1,600–1,700 today, and the top of earnings that announced yesterday, combining that with the middle finger action around here, bearish crossover on the MACD that's developing, multi-top formation, double. You got top 1, top 2, top 1, top 2. The stock continues moving lower. Combine this with the RSI divergence. The next move is lower, so short the damn bounce fearlessly. Entry, again, looking at this daily chart, if this stock gets today to 550, 555, this is your area where you want to enter, considering also the confirmation of the accumulation distribution head and shoulder formation on the daily chart. UNP, this is the greatest puzzle besides the oil puzzle to consider yesterday. This stock announced the worst possible earnings report that the market could have expected. It missed on earnings. It missed on the sales numbers. It missed on every freaking thing it could have possibly missed. And yet, what happens? The stock moves higher. Instead of basically going lower when it bounces here, yeah, it does make it move lower a little bit. So you could have made a little bit of money here. The stock jumps higher all the way to 166 on what? What the hell is this market smoking? Missed on earnings, missed on numbers, and the stock moves higher. Now that was the puzzle of the day yesterday, followed by the puzzle of the day today. Now, and earlier last week, we had another damn puzzle called the DPZ that missed the numbers miserably, projected slower growth in the future, and these JP Morgan guys bought the hell out of it anyways. And the stock failed to still drop until this day as it should have in the first place. So, looking at this crazy, stupid market, what are institutional investors smoking? Well, Crown shares, the cannabis stock, temporarily went up 40% at one point after hours yesterday. So probably that is what they were smoking. However, the other cannabis stocks did not move as much. So that kind of kills that theory there. But nonetheless, guys, the idea is this. Why are they buying stocks that show poor projections for the future? Why are they buying stocks that keep missing the earnings? The only answer is they are hopeful of the Federal Reserve cutting interest rates. And what will actually happen when they don't cut the rates this time around? I think we just solved the DPZ puzzle. I think we just solved the oil puzzle, which is about to drop. UNP could be the greatest short of the day for today and next week, because this thing will go down. It will not survive. Complacency kills bull markets. Guys, the biggest crash of all times in 1929 happened when everybody were just buying stuff because they were buying stuff. Because it was easier to borrow money on margin and buy stuff. Just like the United States consumer is doing today. Why are they buying? Because it's easy to borrow. It's not because they're paying off their stuff. It is because it is easy to borrow and spend the stuff that you borrow. So there is a fundamental flaw. Now, you may say this fundamental flaw has been developing for years. Yes, the rally, the greatest bull market of all times from 1918 to 1929 was born for the same reasons, followed by the greatest crash of all times. And this is where history is going to be made, because this market will be remembered not for the complacency that it is going through right now, but rather for the sharp drop that is about to reveal to us. So stay bearish. We're just a few days away from a big drop. Yesterday, October 17th, Thursday, was another move 11, which is a top information. The market jumps to 3008, surrenders the gain promptly as all drops, regains some as all moves higher, surrenders again when all's reversion again for the day. Two-day sequence 1111. Guys, this is a thing of beauty. 1111. If it's going to be followed by a move 6 today, this market is going down. There's no doubt about it. And I know you're sick and tired of hearing about it, but guys, I don't trade the markets one side or the other unless there is a reason for it. And when the charts point to a continuous move 11, I cannot ignore it. That leads to a drop. No matter what they say about in the news, no matter how complacent the market currently is, these move 11s lead to a freaking drop. So here it is yesterday, move 11. Here's another move 11 today. Here's the move 11 pre-market. Here's the move 11 yesterday pre-market. Here's the move 11 intraday. Here's a smaller move 11 later in the day. 5-day sequence 6, 5, 5, 1, 11, 11. 6 and 11s. When these things come together, guys, the 6s and 11s, and the market is all-time high, it is the top that you want to short. 5-day chart sequence reveals that these 11s, as the market grinds higher, are the dominant behavior of this market. So as many people will tell you right now, buy the damn dip. I dare that you don't. I dare you still faithful as a bear to this market that is about to crash. Without any further ado, today we are expecting a move 6, 2, or 11. VIX review. Clearly, VIX is jumping higher as the market moves higher, which is highly bearish for the market and bullish for the VIX. We're still buying puts and bounces. Even though VIX is numerically low, it is about to break out higher. True trend reversal opportunity could be very much in the making right here. If you zoom in on a 5-day chart of the VIX, we're noticing a clear head and shoulder, reverse head and shoulder formation. That is, here's your reverse shoulder 1, here's your head formation, here's your reverse shoulder 2. Typically, this leads to a breakout higher in whatever chart you're looking at. So, key takeaways for the day: short the hell out of this market, 29.94, 3008 area. Short cloud, semis in all stocks, position for a drop as the top continues to fail. Do not fail yourself, guys. Stay true to what the charts are pointing to. As difficult as the markets have been in the last 2 weeks, I have never lost the war with the market. And this time, this win is going to be more phenomenal than ever before. Let's roll. Charts don't lie. Victory is to follow shortly.
Can't you see that